this is a very difficult exam, and with exams that are well designed like this, exam prep is tougher. Honestly, it's tougher to sort of game an exam when it's not all gimmicky. And when an exam is a poorly constructed exam, and you go through a prep like this, you can often destroy the national averages, but just to beat them is good. So that's yeah, that's good. That's reassuring. And I would echo, I'll talk about this later on today, Sarah's comment about the practice exam. We'll talk about how to use that practice exam to its greatest effect. And I will talk about some of the things to do to relieve stress as well. Sarah is exactly right here that stress is a big opponent of folks writing this exam. And I think it's important to, going into the exam, take the approach, just like Sarah said, that getting to the exam, writing the exam is the step. And what I find sometimes happens is people sit down to write the exam and create so much pressure on themselves when they say somehow, if I don't pass the exam, that it's a reflection on me personally or something like that. And it's not the case. The exam is the exam. You're going to have questions on there that you know and questions you don't know. You'll do your best to prepare for it, but you can't hinge everything on your result on the exam. You really have to say getting there is a success. And actually, honestly, right now, the way the program is changing, writing the exam is a success because it locks you in to be able to write the exam going forward. So whether or not we want to look at it that way, it's a big accomplishment, both intellectually and materially in terms of getting to write the exam. So yeah, thanks, Sarah. That's awesome. Okay, yeah, webinar is posted, Johnny. It's all posted up there already. Yeah, the last 2 days of recordings are posted. Okay. Yeah. All right, we have a bunch of stuff to get through today. We're obviously going to do some questions. We left off midway through Peter and Cindy yesterday. Yeah, that's awesome, Sarah. Look forward to seeing you at Financial Planning Week. And I appreciate the opportunity as always. Thanks so much. Really great group you put together here. And that makes a big difference as to how the class runs. Okay. And I did figure out one of the hashtags anyways. That was good. I think I tagged you in a post yesterday. So good stuff. Okay. I got it from Delene's post. It's nice. So today we're going to talk about multiple choice. We didn't do any multiple choice yesterday. I had asked if people would take the opportunity to do 2 or 3 multiple choice questions. So we'll shuffle that down here. We're going to spend a fair bit of time today talking about exam day and time management to go along with that. I'm not going to do that until a little bit later on. We still have 5 or 6 folks to trickle in, and I prefer to do those kinds of things when we have the whole class here. And we're going to, I don't know if we'll actually finish exam 1, but we'll do as much of exam 1 and the one question several of you asked about from exam 2 as well. Now, in addition to that, are there any other questions that people might have? Anything that's lingering out there? Anything that we know we want to review? Did anybody think of anything when they were going through their studies last night or along those lines? And exactly as Sarah said, you're more than welcome to post on the forums. Sure, Brian, yeah, that's a fairly complex question. And it kind of ties into the question we're working on right now, Brian, doesn't it? Okay, yeah, if it's specific to that question, Melissa, maybe this is a good time to ask it.
Hi, can you hear me?
Sure can, yeah.
So I thought it might be easier just to ask.
Yeah, absolutely, yeah.
Yeah, so when we were selling the land and the building as a package, the 450,000 taxable capital gain, would that be eligible for the lifetime capital gains exemption? Like if we assume it was a CCPC and it was a qualified small business corp,
right?
Or is it not an active asset?
I was going to do this little exercise yesterday and I thought, it's probably a waste of time. So there was actually a ruling recently, and the short answer is no, that would not qualify for lifetime capital gains exemption in almost all cases. And there's a recent ruling that I find very instructive for this purpose. It's, you're gonna think I'm crazy for a second here if you don't already, but that's not bad. Gold star to the first person who can identify what I'm drawing here. Not a caterpillar. I knew somebody was going to guess either a caterpillar or amoeba first. This will help right here. Close, that's close. Definitely not a bacteria with flagella. Nobody's with me here. Cul-de-sac is a very close answer. It's campground. Look, see, campground map. Nice, Joan, I like it. This is my, my campground. And what happens with a campground is, and actually if you, and I don't know, Joan, you might have actually heard this example when you went through accounting school, but it's very common that accountants use this very thing as a case study in active and passive income. And what they would say here is something like this, that I would have passive income if I rent out campsites, and that's all that I do. That's my primary source of income. That's passive income. And that means that it would be taxed as passive income, and that it would then, if sold, it's a passive asset, so no lifetime capital gains exemption. That's fair? And so what accountants will typically recommend, and you see a lot of this in Northern Ontario. Who do we have sort of in cottage country in Ontario, in the Muskokas, or maybe over by Peterborough or Kawartha Lakes? Well, that's kind of the question, Connor, right? Because you don't want that active or that passive income. You want passive income, right? So how do I make this active income? There you go. And Shelley, you've got tons and tons of these private campgrounds close to where you are then, right? Okay. Where all those pesky Torontonians make the trek up to see you every long weekend, right? And I've got this this active income. I can turn this into active income, and this is sort of the answer to your question, Connor. If I'm not renting out campsites, but rather I have campers who pay me whatever, 20 bucks a night. And for that $20, they happen to get a campsite. Sure, that's fine. But that's not the bulk of what they're paying for. They're paying for firewood. They're paying for me to go chop firewood for them. They're paying for me to clean the site. We might have kids' crafts on site, or maybe mini golf. Okay, well, 50 bucks a night then. I'm in Alberta, it's not that expensive. All right, but anyways, or if you go across the States to like KOAs, they're like 8 bucks a night. All right. Kids' crafts, mini golf, whatever else we have here. Maybe you have music nights. Okay. Everybody with me there? And the traditional teaching for accountants has been that's where you convert that now into active income. The campsite is really secondary, and it's everything else that makes it active. That's good. And now you would have an active business income. If you're incorporated, now you're at about, in Ontario, you would be at, what are we at now, a 12.5% tax rate on small business in Ontario. I believe that's right. Versus my passive income over here, which is pretty complicated. It's kind of, it's not exactly right, but kind of a 50% tax rate. So you have a, well, okay, now it doesn't matter at all, Martin. Okay, so it's CRA really, Coralie, right? It's CRA who determines whether something is active or passive in accordance with the language in the Income Tax Act. So this has been sure, yeah, absolutely. You would go to your accountant and your accountant would say, here are the things that you want to do to convert or to make sure that your campsite generates active income. And now you would have the lifetime capital gains exemption available. Okay. However, with a recent Federal Court of Appeals ruling, this is no longer the case. With a recent Federal Court of Appeals ruling, they've said, in fact, most of these kinds of campsites are actually passive, that still the bulk of income comes from renting out the campsite. And therefore passive. Which, fine, that robs you of the lifetime capital gains exemption, and that's a problem. But the real problem here, and what you should be primarily thinking about, in my opinion, with active and passive is not the lifetime capital gains exemption, because that really only matters when you sell your business, but this additional, call it 27.5% tax liability. Sorry, 37.5% tax liability. So that's really where you get into a problem. In order for rental income to be considered active, you have to have at least 5 non-family, sorry, more than five, non-family full-time employees working in the rental business. Right, the federal tax rate is 9%, Connor. That's quite correct. The federal tax rate on that small business is 9%, but in Ontario, you also have a 3.5% provincial tax rate on top of that for a combined total of 12.5%. I'm pretty sure I have that rate right. But yeah, you're right to mention 9% there. If you were in Manitoba, for example, then that would be 9%. Manitoba taxes, or Manitoba does not apply any income tax to small business income. Yeah, exactly, Brian. It's the same in all 3 provinces west of Manitoba. Yeah. Okay. Yeah, but you don't have to memorize that. Corporate tax rates are certainly not something that you would want to necessarily carry around in your head. What you do want to know is that active income is taxed at a far lower rate than passive income. Okay. Now, was that really an answer to your question? Okay. Perfect. You didn't think you'd get to see artwork today, did you? Okay. I think that's good. All right. Yeah, pictures are always helpful, Melissa. I do agree. I like pictures. That's an easy one to do a picture with because, of course, I'm a professional campground drawer. All right, let's see if we have any volunteers. We left off yesterday at question 15, the first half of the Peter and Cindy question. Anybody want to volunteer for the second chunk or the last chunk of Peter and Cindy? And this will take us into the RDSP discussion, or at least we'll have the chance to talk about this following this. This will be Peter and Cindy question 16. Anybody out there? I mean, I can talk about RDSP while we get our steel up to volunteer if you want. Just so on your shortcut menu, Shelley, you'll see the little blue box. Yeah, go ahead, Chris, that's good. You'll see the little blue box with the white camera in it. That's the screen, Shelley. That's your shortcut. Okay. Just take the space out there, Chris. Just if you double click between the pages, you will be able to compress that thing. That's close. If you hold it right between, right in the little gray area between, you'll get the disappear icon. Yeah, just a little bit down from there, like right in that gray space. Yeah, right there. Oh, thanks, Mom. Yeah. Ah, right there, right there. That was it. There you go. Thanks. And now you scroll up a little bit to grab the question for me. That's good. There she is, Brian, eh? All right. Thank you. Shelley, do you have your screen back? It's weird that you have the chat, but not the rest of it. Check up in the top middle of your screen. Shelley, you might find it up there. You might find a little black bar hanging up there. Yeah, perfect. Okay. What kind of question do we have here? What are we looking at? It's true, it's a disability insurance question. And that first step, collection analysis recommendation, this is pretty recommendation-y. Yeah, we're actually telling him what kind of disability insurance to buy. All right, so thanks, Chris, that's good. And what's the next thing that I want to pay particular attention to? I got a mistake in my template again. So I should be looking at my marks, right? Make sure I understand where I'm getting marks. And here I have to fill in both columns to get my marks. Okay. What do we think of the amount of coverage at $5,000? Is that a good answer? I think most people who have sold some disability insurance at some point are going to get this right. Somewhere in that vicinity, Malcolm, and I would suggest if you gave an answer somewhere between 4,500 to 5,000, that would be about right. You might argue it'd be a little high, but if I'm dealing, we don't know what's going on with his business. There might be some stuff in there we can use to inflate that a little bit, Melissa, right? Sometimes you get that with that self-employed person. You look at an RBC policy for self-employed, you can get a little bit more juice out of it sometimes, right? Yeah, that's it, Malcolm, right? Okay, so somewhere in that vicinity is going to be good. What would be wrong here is if you did 100% of his income or something like that. If you did somewhere in that 2/3, give or take range, you'll be okay. Okay. Now, what do we think about the rationale for this? That might be okay, Melissa. Again, that just shows that you understand how it works. It's really all I'm looking for here. I do think that's a little bit lower than what you would find in real life. But yeah, he might have said approximately 70%, Connor. That might be the right language to use here. Okay, roughly 70%, something like that. Nevertheless, what do we think about this answer? Yes, 2/3 is fine, Sharon. Yeah. Yeah, gross income, pre-tax income, whichever. What's the rationale? What does Chris's answer actually explain? Yeah, I think that this is kind of the challenge. What's the assumption that's inherent in Chris's answer? Yeah, exactly, Joan. That's right. It is after tax. He's going to be paying for it. There's no other way. He doesn't have an employer to pay for it. So it has to be paid on an after-tax basis. But I'm going to point something out with this answer. And I think this is a very frequent rationale that we give for selling this insurance, but really, why does he need this much insurance? If I gave this same rationale for a life insurance answer, yeah, exactly, he cannot. Joan agreed. Okay. What if for life insurance, I said, this is the maximum he will qualify for? And that was the only rationale I gave. Is that a valid rationale? Does that explain why I'm selling that amount of life insurance? No, if I'm looking to support a life insurance sale, what has to go along with this? Yeah, that's when we're selling insurance, there has to be a needs analysis, doesn't there? That's right, isn't it? That's part of your reasons why letter. That's part of your most basic, and I know this is what happens with disability insurance. I get it. This is the inherent bias that I find with disability insurance questions. But did we do a needs analysis? Okay. Did anybody give a needs analysis type of answer here? Okay, that could be it, Melissa. Right, something like that, Boston. That would be a needs analysis type of answer. Okay, so current monthly expenses, perfect. A bit of retirement savings. Yeah, I can live with that. That's a good basic needs analysis. You're not showing a bunch of math here. Okay, and maybe you might talk about keeping his business expenses or something like that. Okay, although I think there's a better answer for that, but that might be something else we give. Okay, is everybody with me there? Does everybody see that because it's the most you can get is not a rationale for that amount of insurance? We want to be careful what assumptions we're making when we provide an answer like this. And this is the dangerous thing with recommendations. It's hard to see sort of internally what assumptions we built into it. Okay, that's good. So if you want to take that into account, Shelley, you would still say he might have higher expenses, but that's the most disability insurance he can buy. Well, what we do know in the question is that their annual expenses, so we know what their income is, Connor, right? Their incomes are $86,000 for Peter and $34,000 for Cindy, so a combined after-tax $120,000. And we're told that they have annual expenses that leave them about $10,000 of unallocated cash. I know their expenses are about $110,000 a year. Okay, sure, I don't get a full workup as far as it's in there. I know, Connor, it's in there, and I know that's frustrating. That goes back to, it's one thing to kind of read this on the fly as we're working through it here, but if you made notes and you slowed yourself down and took that 8 to 10 minutes to read it, that makes a big difference. Nice, Connor. All right. You with me there? So if you're finding that that's a genuine problem you're having, then again, I want to emphasize that. You come back to your scrap paper, you make good notes, you slow down your reading of the case study. That will help. Okay. Everybody's with me there. Remember, my guideline here was that you're going to have about 20 to 24 minutes or thereabouts per case. And of that time, half should be reading and prep, and about half should be answering questions. You can't rush into answering the questions. You have to make sure that you know the client you're dealing with, just like real life. Okay? If I was in a real life situation with a client and I don't let that client finish telling me their situation and I start making recommendations, how's that engagement going to go? So clients like 15 minutes into telling me their life story and I'm like, yeah, shut up. I know what you need. Good. And that's kind of what we're doing if we don't take our time and read the case study. All right. Then we look at definition of disability. Well, you kind of have that opportunity, Justin, but you want to let that opportunity pass you by on the exam. Okay. That's good. All right, what do we think about an own occupation definition of disability here? Yeah, I'm with you, Nick. I don't think he's going to qualify for own occ, and I'm not sure it's needed. Now, he might qualify by accident. I know with Canada Life, you can sort of accidentally skip into own occ, at least a couple of years of own occ, right? But I would suggest that given his occupation as an electrical contractor, I think own occ is pretty unlikely. Now, if somebody's, sure, you might, if you've underwritten somebody as an electrical contractor with own occ, I definitely would, but that's the last question, Martin. We'll get there. Okay. No, I don't, Shelley, but I have to know what does qualify for own occ in general. What kinds of things qualify for an own occ definition? Yeah, usually, and it's not that it's a list, it's a set of principles here, right? So we normally look at professionals, especially medical professionals, right? We can look at doctors, dentists, lawyers. Even some insurers today are hesitant with dentists, aren't they? Okay. Financial planners, Shelley, yeah. I think insurers sometimes make that distinction. Okay. Is that true, Shelley? Are you getting underwritten for own occ today as financial advisor? Okay. That's good. Run with it. Don't let that policy go, because that's one that comes and goes. Okay. But yeah, these normally white collar jobs with little physical risk. Although arguably both dentists and financial advisors have some physical risk, but whatever. So I don't know. If you've seen own occ for an electrical contractor, let me know. I haven't seen it, and until I do, I'm going to continue to say that regular occ would be more appropriate here. Yeah, I know we always want all of our clients to get it, but have to be realistic about what's available too. Okay. Now, sometimes when I present that, people say, well, Jason, you said to describe the ideal coverage, and I would suggest the ideal coverage is something he actually qualifies for. Yeah, for a professional engineer, I absolutely agree, Malcolm. He's not a professional engineer, though. Okay. It's all of us, Melissa. There's nobody who doesn't have that problem. Okay. Yeah, I understand that, Melissa. I appreciate you bringing that point up. That's funny that you and I came to that at the same time. Um, I would mark it wrong, Coralie. I would definitely, knowing what I know, I would mark ONOC wrong. What you'll find, though, in the group of graders, there'll be somebody in the room who does a lot of disability insurance work, maybe somebody from like Canada Life's Product Solution Center or something like that. And they would say, well, actually, in fact, 10% of the time, electrical contractors get underwritten as ONOC. So there will be somebody who knows who would give that answer. That's why I say if I see an ONOC policy this way, then I would happily change that. I think I asked my RBC guy this question about 3 years ago, and at the time they were not. Okay. Now I know if he had a bunch of employees, if he's more in a CEO type of role, well, maybe then. Okay. And I did try to write it with an occupation where it's not too much on the fence. Okay. All right. Now this rationale would match ONOC. This is a fine explanation of ONOC, but I'm not sure that it's still a rationale. What's the, it's a hard one to rationalize. It's hard to do this when you have that first part wrong, but of course this mark does have to be available even if that first part is wrong. I don't know. What do we think about this rationale? Yeah, now they're not going to do that, Nelson, right? Because even in an ENIOC definition, your definition is for an occupation for which you're suitably educated, trained, or experienced, right? So you don't get that that big downgrade necessarily. But yeah, I might point to, it's hard because I don't like the ONOC answer in the first place, so a good rationale, but you might point to this where you say, maybe it allows him time to recover. I struggle with this one a little bit. Allows time to recover and go back to his occupation. If you're going to go with ONOC, that's really what ONOC is for. Okay. Yeah, that's it, Tim. It's kind of a tough one, right? I know I hear that all the time, Nelson. Back in the day, the story used to be that they would make you stand on the street corner selling pencils. And then for a long time, it was the Walmart greeter. Okay. And now you hear the call center thing. But the wording in the policy, if you, whether you're ONOC, ENIOC, or regular OC, is a job for which you are suitably skilled, educated, or experienced. Okay. If you actually look at your regular OC definition or your ENIOC definition, you'll still find that language in there. Okay. The benefit period and waiting period. Yeah, other than his own, I could go with that. Yeah, Connor, that's fair. Okay. I do agree with this as a waiting period and benefit period. I would definitely give those marks. What about the rationale? Okay, I think this is good. There's maybe one comment that I would add to the 90 days. I don't really care about the higher premium. I'm still trying to insure him for the risk he actually faces, but I might comment here that, yeah, I get it. That's a picky word, that permanently disabled. You might have said a long-term disability. I think it's okay here. Right, I would want to point to why 90 days is okay. Yeah, I think that's the point here, Shelley. Because they are good savers, they have a bit of cushion, and 90 days is likely okay. Now, there is a corollary to that. What you might have said here is you say they haven't saved anything because there's no indication they've been saving in an emergency fund type account. So yes, they've been good savers, but no indication of emergency savings. So maybe you need a shorter elimination period. And that's where I think that 30-day answer might be appropriate. So I think you can support a couple of different answers here. I think you can support 90 days, or you can support 30 days. And that's where I have to figure out really just which of those answers I want to use. Right, so he's self-employed, David, right? And as a self-employed person, yes, he can opt into EI. There's no indication that he has. And given that he's self-employed, fine, you could do it. But even then, if you end up on medical EI or accident benefits from EI, sorry, sickness benefits from EI, I apologize, that does not replace the kind of income he makes, right? He would end up with about a 30% income replacement like that. Okay, and then somebody did make this good point. I like this other answer too. Right, you can't assume, Connor, that your question 15 answer is part of your question 16 answer. No, that's not good. Yeah, you self-employed can opt into EI, Brian. Sure you can, but you have to actively opt into it. Yeah, that's what he doesn't have it by default, but don't say he wouldn't qualify for it, right? You could say there's no indication that he has opted in. That's fine, and even then, it's not enough money, right? Whoever raised this point before, so this is a good point too. We might talk about he is the primary income earner and income until 65 is valuable for the household. Okay, that's all good? Yeah, it's not enough, Brian, right? And it's taxable. Okay. What do we think about the cost of living adjustment? Some sort of inflation protection. I don't care what you call it. Yeah, I think this is a good one. And I think I would give the mark here. The only sort of assumption that's made that you didn't specify, Chris, it's because he's relatively young, right? That's the benefit here. He's only in his late 30s. A disability for him could last years and years, but I think it's inherent here. Okay, that would be the first one I would look at. I like that. My preference, actually, though, my favorite here would be, yeah, agreed, Brian. It doesn't have to be permanent, does it, for this to be true? I would watch that a little bit, maybe consider instead of permanent, maybe a long-term disability. Okay. Again, I'm not sure how picky that would be, Brian, but it's a good word to pick up on here. I don't think you're wasting your breath with that suggestion. Yeah, you only need one rider. The question is very clear here, Tim. Indicate one rider. Okay. And I don't know if you remember, I talked about this before. I talked about this a little bit on day one, but let's say you were, oh yeah, I know disability insurance. I know it well. And you put cost of living adjustment, and then you also put business overhead, which I think is a good rider for him. And then you also put a future income option or a future purchase option. And maybe you say, well, he does a dangerous job, so I'm going to throw in an accidental death and dismemberment benefit. I always do when I deal with contractors. They're perfect. I just keep piling them on, Justin. There we go. Sure, a second event. Although disability, do I need second event? That's only for CI. Yeah, return of premium, Coralie. Right? Okay. Sure. There. See, we can just keep piling them on, Boston, right? And now the problem is I have to write a rationale for each of those answers. And with every item that I add, then I increase my chances to get it wrong. That's exactly it, Brian, right? This is bad odds now. And I would actually mark accidental death benefit wrong. I would say no. If he needs life insurance, sell him life insurance. That's not a good answer. Get rid of that thing. Okay. And the problem here is if you have 4 right answers and 1 wrong answer, you still have a wrong answer. Okay. Now that being said, and I think Malcolm, this was your point earlier, I really like business overhead expense in this point. In this case, I would absolutely put BOE in place. I like the inflation protection too. My concern with inflation protection is sometimes the cost. But yeah, that's exactly it, Natalie. Yeah. So. Right. That would be a different question. The problem, Tim, is it would be very hard to grade that. Okay. It would be very hard to write. You have to think about the exam writer here too, the exam grader. The folks who put together the exam, they have to build something that somebody can actually mark. And if you build this sort of unlimited number of decisions, well, you have a challenge there, right? And it's sometimes useful from that perspective, Tim, to get into the head of the grader and to say, okay, when my grader is grading this thing, what are they really going to be looking at? And here, you have to recognize that that person really just wants to see one answer with one fairly concise rationale. Okay. Questions there? All right. That's good, Chris. Lots to learn from that question. I like this question. First off, because I deal with a lot of insurance folks, and I find for insurance folks, it can show us a little bit of where sometimes we just jump to conclusions without actually having thought about how we're getting to that conclusion. It shows when you're comfortable with a topic where that can come back to bite you. And also because we're not too concerned about technical here. Everybody kind of knows the technical side of this. Yeah, and that's it, Melissa, right? It's a very common thing. Yeah, that's good, Chris. I appreciate you sharing. All right, thanks for getting us started, Chris. It's real good. Okay, let's have a look at registered disability savings plan. and buyback of previous years of grants. Now, in the Peter and Cindy case, there would be no buyback available. And why not? There'd be no prior years of grants available. Why not? Yeah, newly diagnosed, Margaret, exactly right. It does sometimes happen that we retroactively apply for disability tax credit. That's a different case. It may have been that he was diagnosed 3 years ago. This could be up to 10 years. He's not old enough for that, but up to 10 years is possible. We can get the disability tax credit retro and then also the RDSP. Yeah, that's it, Connor, right? Based on when the disability tax credit came available. Okay. Let's say then that I run into this scenario. This is pretty complicated, and I'm going to show you kind of what you have to know for exam purposes, because the real life complexity here is probably too much for your typical exam question. Let's say that I have this scenario. I'm going to draw a little timeline here. With any question like this, your scrap paper should include a timeline. Draw your timeline, just like we draw a line for a time value of money question. Here's what I have. I have a client who has a child, age 23. Okay, turned 23 this year, so started the year at 22. And this child has had a disability since age 13, has been eligible for disability tax credit since that time, but we have no RDSP in place. Okay, this disability is expected to be permanent. And in addition to being permanent, this child has, let's say, a long life expectancy. You would not normally set up an RDSP for somebody who has an impaired life expectancy. It generally does not make sense for somebody who might die in their 20s or 30s, although there's a little bit of latitude for that. You can use what's called the specified disability savings plan, which is where you flip your RDSP over to an income type of plan, but that only works if a physician says, yes, this person has less than 10 years to live. Sorry, 10 years or less to live. So that's a tough thing to qualify for. You really have to have a condition where that premature death would be somewhat predictable by that physician. Okay, we've never set up the RDSP. And here's what we have. The child's income is less than $20,000 a year. The parents' incomes combine to greater than $100,000 a year. And that's been true for whatever, for 20 plus years. Okay, everybody's with me here? So now we're starting the plan. And what's going to happen here is we put our first $1,500. Let's assume the parents have maybe not an unlimited amount of money, but they have a lot of cash on hand that they can use to fund this thing. So for starters, we put $1,500 in, and that will get the 2019 maximum grants. And that would be the first $500 gets you a 300% match. and the next $1,000 gets you a 200% match. So $1,500 gets $3,500. That's a total of $5,000. Everybody's good so far? And then I will do the same thing for some of our prior years. For the years the child turned 22, for the year the child turned 21, for the year the child turned 20, and for the year the child turned 19. For each of those years, we have also the 300% on the first 500 and 200% after that, or sorry, on the next 1,000. Okay, what I would look at then, and this is what's going to happen, you apply for the disability tax credit, and then you're told yes, you get that, and then you apply for the RDSP, and then in around April of every year, CRA will send a letter that says, hey, here's the most grant you can get, here's how you would get it, here's how much you have to put in to get that. Has anybody seen that letter? Yeah, pretty handy actually, because it saves you having to do this math. But if you have a client who has a disability tax credit, they do get that letter every year, and you should ask them to set that letter aside, bring you that letter, because it will help to optimize the grants and really save you what is a very challenging bit of math. So that's 4 years. I don't know if it does, Martin. Sorry, I know they get the letter, but I don't think it shows up on your CRA online account, your My CRA or whatever. Yeah, I didn't think so, Natalie. Thanks. Yeah. So we would put 4 years at $500 in to get our 300% matches. That's $500. Then, sorry, that's $2,000. I apologize. $2,000 gets $6,000. So that's going to be another $8,000 in total. Now, why can't I get that money for age 18? What's wrong going back to age 18? That's when it would have been based on the parent's income. Exactly. So it's just a 100% match. You can only go back 10 years, Sharon, a maximum of 10 years back. That's the first rule we have to consider. Okay. That rule only actually became material this year. This is the first year that mattered because the RDSP was introduced in 2008. This is the first time that anybody would have even had the possibility for that to be a concern. So max of 10 years back. And then that's $8,000 in total. And so far, we've gotten from our combined sources of grants, that's pretty close, Melissa. Yeah, we're going to see that rule right away. We have $9,500 of grants so far. Everybody agree with that? 6,000 plus 3,500 is 9,500. The max grant you can get in 1 year is $10,500. You can get up to 10,500, which would be 3 years at the high rate. Okay, and therefore, that 10,500, I would just put in another $1,000, And that would actually be allocated against the best year it could. This is how CRA will calculate this. We would look back to the year that this person turned 19. It's not too much, Connor. Have to have disability tax credit, have to have a social insurance number, have to be a resident of Canada. It's all the same stuff as an RESP other than add-on disability tax credits. Okay. We'll talk about the bond in a second, Melissa. Let's leave the bond out for now. We're complicated enough already. Yeah, exactly, Luciano. Once you are an adult, then we only look at your income plus your spouse's income. If Yuri gets married when he's 21, then we would bring his spouse's income into this calculation as well. Okay. But he doesn't have a spouse, so but yeah, once you're an adult, it's called your adjusted family net income, and it's only your household income once you're an adult. Right. It's just that 100% match. That's all it is, Connor. It's the cutoff is about $90,000, and then it's a 100% match on a contribution of up to $1,000. Okay, so now at the turn 19, we would add another $500, which would attract a 200% grant. That's $1,000 more of grants. Everybody with me here? So what we put in total, and you see how complicated this is, right? This is a very complicated transaction. It's different in every single case, but the total contribution here was $3,500, $4,000. The total grants were $10,500. Well, I think that's bad math, Sharon, right? I hear that all the time. And I can, somewhere I have an Excel spreadsheet where I calculated that. But really what you're saying, Sharon, when you say that, is that you're better off to wait 20 years to get a 300% match than you are to get 20 years of tax deferred growth on that $1,000. Are you with me there? We could do the time value of money for it, but yeah, I hear that all the time, Sharon. Now, there are other good reasons to wait until adulthood to start applying for RDSP. One of the mistakes I see sometimes, Sharon, is that people are in an anxious rush to set up the RDSP. And I don't know if anybody listens to my podcast, you'd have heard this, but it is actually very common. The statistics here are actually frighteningly high for somebody who qualifies, especially based on a mental disorder, where the disability tax credit has to be renewed every 3 to 5 years. I'll answer your question, Gina. I haven't forgotten. Okay. And about 1 in 6 of those claims, those renewal claims, get rejected. So you have an 11-year-old child who just qualified for disability tax credit, and the advisor says, oh yeah, perfect, parents, have I got the plan for you? And we set up the RDSP, and then at 14 or 15, that child gets a letter from CRA that says, hey, it's time to reapply for disability tax credit. Well, for just playing the odds, 1 in 6 kids in that instance are going to get their disability tax credit claim rejected, which, as the rules are written today, is generally going to compel a collapse of the RDSP. You can't, Brian. That measure was in budget 2019, and I was super excited too, Brian, but the measure actually never got royal assent. Yeah. Yeah, silly, eh? Okay. Now, I'm not sure Yeah, I did. I think you just got your answer, Nick. Okay. There was not a change. There was going to be a change, and it never got the rail ascent that it needs. Okay. So Gina, do I want the max grant? The parents have money, right? They want to get as much grant money as they can. Is that fair? There is $10,500 is the limitation. They can get up to 10.5. And when we're only using the 300% amounts and the current year, so you have to do the current year first before you get any buyback. And they've done that. And then they got all their 300% money. And now we push to, or we get those other years back, those earlier years back. Okay. Is everybody with me there? The contributions all happen this year, Tim, right? The contributions get allocated to the prior 4 years. So I allocated $500 a year to the prior 4 years here, and then another $500 here. Okay. Is everybody good so far? This is the question. These are the questions you should be asking, because I'm going to do another year, and now it's going to get real messy. But you're going to see why this is not really a great exam question. Now, you have to know all of this. This is all relevant, but the buyback calculation, or maybe it's a really great exam question if you're willing to, and this is the problem, is the exam writer would have to say, we're going to really allocate a lot of marks to this thing. Okay. Yeah, the first year is easy, Coralie. And we haven't even talked about bonds yet. I can't remember who mentioned the bonds, but we'll do the bonds later. Okay, so Melissa, you know the rule is 300% on the first 500 and then 200% on the next 1,000. Okay. So this family hasn't gotten all of their 200% grants yet. Agreed? Yeah, that's just to get to the max. Right now, if we just stopped at the 300%, the current year and the 300%, let's say we'd have 9,500 of grants, but the family says, well, can we get any more? Sure, family, put another $500 in. That gets you another $1,000. Any more than that would attract no more grant because now we've maxed out our grants. But that extra $500, that gets you that instant $1,000 or relatively instant $1,000 added into the plan. No, they never did, right? There's no RDSP in place. We just set up the RDSP. This is the first time we're setting up the RDSP, right? Remember the question is about RDSP and grant buyback? No, they didn't do that. They didn't know about the RDSP, or they didn't know how to set one up, or whatever it is, but they did not have an RDSP. Okay, they've just set it up for the first time. Okay. They can actually go back as far as 10 years. Melissa, now, okay, so you're doing something different here, Melissa. What you're assuming is that you get age 23, then 22, then 21, then 20. Is that the assumption you're making? But that's not what happens. You actually get your highest level of available retro grant first. So you get your 300% money first before you start to use your retro 200% money. Which is what makes this such a complicated scenario. But that's better, right? That is the better outcome. Okay. Now, the year the child turns 24. Ooh, here we go. Okay, child turns 24. Okay, and that year, once again, we put another $1,500 in, and that gets $3,500 for the current year. There's no more 300% money left after that. Do we agree with that? We bought back all of our 300% grants. And now what we're going to do, we're going to go back to each prior year. For age 19, we're going to put another $500 in, and that gets another $1,000. For age 20, we're going to add another $1,000, which gets $2,000. That's our 200% money for age 20. For age 21, we're going to add another $1,000. That gets another $2,000. We're now at 8,500 of grants. We used it last year, Sharon, right? We got to 10.5 last year using the 300% money, right? There's no more 300% money because we exhausted it all last year. Okay. For age 22, we're going to add another $1,000, and that gets $2,000 more of grants. Okay, that brings me up to $10,500. Yeah, $10,500 of grants. I used $500 of the age 19 amount. That still leaves me $500, Shelley. Right? There's $1,000. It's 300% of your first 500, and then a 200% of your next 1,000. Okay. Man, I hope you guys have this question on the exam now. All right. The 10.5 of grants. Okay, well, whichever, Connor, I guess, right? Now we've maxed out our grants. Everybody agree with that? No more grants available this year. And this year we put in contributions of $5,000, and we got grants of $10,500. That's all good? Yeah, we haven't touched the bond at all yet, Malcolm. Again, I got to keep this simple, right? By not bringing the bond into it. We'll just do one more year. We did get a little bit of 300% money that year, Sharon, right? We got it for the age 24 year. That there's a 300% grant in here. Agreed? The first 500 was at 300%. But yeah, other than that, I've exhausted all my 300% money. Okay, I got my 300% money for age 19. I got my 300% money for age 20. I got my $300% money for age 21, and I got my 300% money for age 22. So I'm not sure what change you're asking me to make, Natalie. Retro 300%. Where would I put that? Like over here? Is that where this would go? Is that what you're suggesting? Well, I did. There's no more 300% money left. I'm not sure what the difference is. I'm sorry. Right? Oh, I understand what you're asking for. Sure. Okay. Like that. All right. Good. The 300%, you're talking about at age 23, Coralie? Yeah, that's right. We got all of our 300% money back here. Okay. Can we just do one more quick year here? And the next year actually will be much easier. Because now we look at age 25. So the year this person turns 25, income is still low. We add another $1,500, and that gets $3,500 for the current year. Okay, and now all my retro 300% are used, and all my retro 200% are used. Now we're going to run into the 10-year limit. Okay, so now we can get 100% matching. That's available for ages 15 to 18. That's 4 years inclusive. Is everybody with me there? So the year the child turned 15, the year the child turned 16, the year the child turned 17, the year the child turned 18, for those years, the parent's income was high, so your matching was just 100%. And you can only go back 10 years, Brian. That's exactly right. That's what's going to bump us into that 10 years. Yeah, 10 years from the current age. Okay, that's as far back as we can go. So we'll add another $4,000 and we'll get $4,000 of grants. Okay, that's good. Yeah, you mean when they tell you when you're going to bump from 100% to 200% to 300%, Connor? Yeah, absolutely. Yes. The letter is pretty clear, actually. The letter doesn't give you all of this crap. The letter just says, if you put this much in this year, that's how much grant you're going to get. Okay. So the letter that they will get the year that this child is 25 would say, parents, you can put in $5,500 this year, and that will get you $7,500 of grants. That's all it has to say, right? So this year we contributed $5,500 and we get grants of $7,500. Again, that's our max because of time, not because of the dollar amounts. It'll give you the dollar amounts, Brian. It'll just say this is the dollar amount. But it does include all your buyback opportunities, yes. Okay. Whew. Come on, that could hardly have been simpler. I could hardly come up with a simpler plan to take care of folks with serious disabilities. It's 4 years at 100% each, Luciano. Right? Yeah, that's the max. When you get the 100% match, I hope so, Peter. All right. Sure. And Tim, if I were writing this from scratch in Excel, I probably could have built a table. Okay. You could build a table. The problem, Tim, is every scenario is different, right? And some people will respond well to a table. Some people will not, honestly. Yeah, exactly, Melissa. At 26, there's no more retro. At 26, it would just be straight up current year. That's when it gets easy. Okay, that's good. Now, I'm going to show you one more thing here. And honestly, Tim, to my comment, if you were doing a lot of this kind of work, yeah, good. Build the table, right? I think it would help people to see the value of it. But again, you'd want to build something that's relevant. The challenge I find this is a real problem with these scenarios. Every scenario ends up a little bit different. Okay. Yeah, it's crazy, isn't it, Melissa? Yeah, that's all you're going to do, Jamie. Yeah. 1500, 3500, 1500, 3500, and on and on and on. Now, I want to show a slightly, just a minor twist in this. Let's say, yeah, it does, Matt. The child, I have that up there. Okay. Child's income would include spouse's income in black. It's sort of the top right middle. Okay. The scenario that I want to show you, let's say I have a client age 52. Okay. And this person has been legally deaf and therefore qualifies for the disability tax credit. Okay, since age 35. You with me here? No RDSP in place. Income's always been good. Income in excess of $100,000 a year. We can set up an RDSP, but you're going to run into a big problem here. And the problem is no grants are available. There is no CDSG available. That's exactly right. No CDSG can be paid for anybody who has hit their 50th birthday. And it's literally as of your 50th birthday that becomes true. And this applies as well to retroactive grants. For this person, I probably wouldn't set up the RDSP unless they're already maxed out on RRSP and TFSA. Yeah, that's good, Melissa, right? Because you get at least a few years, you get some buyback, presumably, and then you're going to get 4 more years. But if your client decided to wait, let's say they decided to wait because they maybe think they're going to get more money after age 50, that would be a mistake, right? They have to get all their buyback done by time they are 49. Okay, can I erase this whole mess? Okay, but you see, you just have to work through the problem. Okay, I have probably, well, just the RDSP, Justin, but no free money. If you're looking for free money, no, that all ends on your 50th birthday. We'll talk about the bonds. I know we still have to do the bonds. Yeah, exactly, Chris. That'd be $1,000. Still worth doing for that $1,000. Melissa's client is still going to benefit from 100% match. It doesn't have to stay in there for 10 years, Coralie, but if you take the money out before 10 years, you lose your grants. Okay, so generally, you do want to keep it in there for 10 years. Otherwise, any grants received in the prior 10 years are lost. Yeah. Unless, again, you have that person who is told they will die in less than 10 years, then you can start taking money out without repaying that grant and bond amount. Except in New Brunswick, Melissa, that's true. That's a benefit. Now, depends on your client situation, but yes, this is a big deal with the RDSP. If you're accruing money within the RDSP, you still get your provincial disability benefits. So AISH or ODSP or MAP or BCEA or SED or whatever program you're on. And if you're just taking your normal income from the RDSP, it doesn't hurt those benefits. Yes, Shelley, although there is a little bit of a provision where if you have somebody who is told that they will be disabled again, so the doctor says not disabled right now, but will be disabled again, then you can keep the plan open until you requalify for disability tax credits. Yeah, you're always going back. It's a last in, first out, Justin, if you want to look at it that way. You're always tracing back 10 years. So no, you can't just wait 10 years and start taking money out. It's always that we look at the grants and bonds received in the prior 10 years. I mean, if your husband, Shelley, had a disability, sorry, had an RDSP in place, that measure that was in budget 2018 would have helped. But yeah, does he no longer qualify for disability tax credits? Did his DTC get rejected? Oh man, because that's the thing that's happening with diabetics right now, right? Is diabetics are using all their therapy time, right? If you're more than 14 hours a week of therapy time, that's still enough to qualify. Okay. No, that had nothing to do with income, Sharon. No. There's no income test to qualify for disability tax credit or for RDSP. Okay, but Shelley, in your case, because it's RA, it is still somewhat progressive, isn't it? I don't know much about RA, sorry. So given its progressive nature, I would wager that your doc will be willing to write a letter that says your husband would be frustrated again, or sorry, not frustrated, that's would be disabled again. Okay, sorry, I was reading your comment there while I was talking. But yeah, that's a way to keep the disability savings plan in place. Okay. It's such a nightmare. Honestly, I mean, I like fundamentally the RDSP, but the level of complexity with it, I just can't believe we drag people through this. Sure, just that one question, Luciano, and then it'll all be clear, right? Okay. Yes, after 18, it's based on the child's income. Honestly, I don't think it is, Malcolm. I think it's a just slow down and work through it question. I really think that's true. All you really have to know here, Malcolm, is 300%, 200%, 100%, and whose income it's based on. Okay. And then you just slow down, just do it one step at a time, right? This is a how do you eat an elephant problem, right? We know that saying, how do you eat an elephant? That's it, Nicola, right? That's all it is. It's just to slow down and solve it one little thing at a time. Okay. But yeah, if you look at this question and you say, I have no idea how to start even, well, that's where you're going to get a problem. And remember what I said yesterday about this kind of question, Malcolm, that if there's a number that's key to the rest of the question and you have no idea how to solve that, but you know if you had that number, you could solve the rest of the question, perfect. Just put a number in there and then go through and solve using that bad first number. You can still get the bulk of your marks that way. Okay. Now let's just talk about the bond. The bond is actually much, much easier. Okay, so at 23, what's going to happen here, and this is where your question again about the incomes becomes relevant. Income is low enough, sub $20,000, actually about $23,000 this year, to qualify for the full Disability savings bond, Canada Disability Savings Bond. Okay. And how much is the full CDSB? $1,000 a year. Okay, no contributions required. It's not a match. That's the maximum amount. Melissa, you're correct. That's the most lifetime you can get. So no contributions required. Just set up the plan. Okay, so we get that $1,000, and just like the grant, we can go back 10 years. To a maximum of $10,000. Okay, are we going to get the bond for age 22? Yes, the bond will be paid. What about for age 21? Same thing. What about for age 20? Okay, that's it, Jamie, right? At age 18, no, because that's where it's based on the parent's income. Okay, but for these first 4 years, it's based on the child's income, or these whatever last 4 years, however you want to look at that. Okay. That's all good? That's much easier, isn't it? It's around 23 to qualify for the full amount, Melissa, and then around 33 or 34 where it's cut off altogether. It's prorated between about 22 and a half or 23, whatever it is, and around 35. Okay, I always have to look the numbers up. I might be a little bit off there, but it's pretty close. Okay. That is not information I carry around in my tiny little head. Okay, good. Good. Let's switch gears then. Yeah, that was a nightmare, wasn't it, Brian? Okay, well, I think we'll do another question here. It sure does. Like that letter, unfortunately, you just don't get the letter on the exam, right? So the letter helps, just doesn't help on the exam. And look at the letter is not an answer for the exam. Okay. It's, you know, I shouldn't say it's, you could have an exam question where knowing that detail would be useful, but if it's a full-on math question, no, you're going to have to go through and do the whole thing. Okay, I do have a volunteer for, yeah, that's good, Nick, exactly right. $70,000 is the most lifetime grant you can get, and $20,000 is the most lifetime bond you can get. Yeah, that's true. Okay, I do have a volunteer for question 17. Yeah, good stuff, Boston. All right, let's see it here. Appreciate that. Just going to grab both of those, just leave them up there. That's good. Okay, yeah, thanks, Boston. That's good. First off, and this would be a fairly typical type of question. What kind of question is this? Question 17. What skill are we demonstrating here? This is analysis. Okay, that's that. Describe 3 factors. Pretty straightforward. That is an analysis type of question. And of course, the risk here with this question, and I see this happen quite a bit, Boston doesn't seem to have done this, but the risk is that you make a recommendation. I find it is very common to run into an answer here where somebody says, Helen should use a TFSA because, or should use an RRSP because. Okay, what do we think of this first answer? TFSA allows after-tax dollars to go tax-free. That is all technically true, isn't it? Yeah, that's right. There's not should, it's could, Brian. That's right. Okay. Now, do we agree this is a technically true answer? Yeah. And that's what I'm going to comment on here, Melissa. What I want to know, and this is a good example of where we can dig in a little bit to this knowledge versus competency issue. So this is a technically perfect answer, right? So I've described the attributes of the TFSA. Why does this matter for Helen? Or if you're pulling from my list of things to consider when you're answering an exam question, so what? Why does it matter that it grows tax-free? Yeah, something like that, Melissa. We could point to ready access for an emergency. Okay, we might point to the fact that she's already doing some registered savings. And this creates tax diversification. Okay, right. Something like that, Justin. That's relevant to her. That's very similar to Melissa's answer. No, I don't think so. I think it still has to be things she should consider, Connor, okay? If my weakness here is in how I wrote the question, that's on me. On the exam, your answers have to be relevant to the client. That is an absolute must. If my language here is not ideal, that's on me. But on the exam, you have to indicate why this matters for the clients. Okay? Simply to list things that are technically correct is not going to get you your marks. Okay, let's work through the 3 answers we have here first. Okay, that's a flip side answer. I like that, Melissa. Let's work through the 3 answers, though, that Boston was good enough to give us. Okay, and again, the same comment here is that, and I hope this is useful, Boston. I hope you see what the issue here is. And again, if it's on me because I didn't express the question clearly enough, but I think it's an easy lesson to pick up on when you get to see your answers like this, right? Yeah. Here, you're not exactly, that's a good break to put on, Boston, when you say without giving the actual recommendation. Did you do capstone, Boston? You capstone, or are you one of the trial students on the PEP? So this is something your capstone course should, okay. Were you going to finish it in time? Are you waiting for your marks right now? Oh my goodness. Okay. That's yeah. Okay. I don't want to comment on that. Anyways, yes, good luck. I hope everybody gets good results back out of that. Yeah. Okay. I didn't realize there were so many of you still waiting for that. That's yeah. That being said, okay, getting ready for this exam is relevant now, and it will be relevant in 6 months. Okay. So yeah. Okay. Well, let me know. I'm curious to know when you get your marks. I'd like to know how that works. I'm curious to see how they. Well, that's fair, Sharon. I would have appreciated it, but honestly, I did not have room in my course. We ran out of room a long time ago. I used every resource I had this summer to bring on as many students as I could. No, so I understand that, Boston, but you should have done some analysis in your capstone where you worked through some what if scenarios for the client, where you weren't making recommendations, but working through scenarios, right? That's enough time, Devin. That's not going to be a problem. FP Canada is super responsive. When you get your mark, if you passed, you'll get your transcript with it. You'll send that to FP Canada. They are good to go with this. Okay. Yeah, nothing to worry about there. That's easy. I find it is very rare that a student runs into any sort of problem at FP Canada. Okay. That being said, I will ask this question. Anybody on the call, I know Joan, you are. Is there anybody else on the call who's writing on the approved prior credentials policy? And Joan, you're aware of this. You've already sorted this out. Is there anybody who did not have to write their level 1? Or is Joan the only one in that situation? Okay, because of pilot. Yeah, that's true. Don't worry about the pilot. I don't care about that. I care about approved prior credentials. If you didn't have to because you're a CFA, charter holder, or a CPA, or a PhD in economics, or I think sometimes, I can't remember how they do it with CLU now. Yeah, okay, that's fine. Then don't worry about it. Well, did you write level 1 though, Luciano? You're a pilot, so you don't care. Yeah. Yeah, with sufficient experience, CLU counts, right? But you're doing the pilot program anyways. Yeah, perfect. Okay, don't worry about it then. It's all good. Because if you're in the pilot program, FP Canada knows about you. I'm only concerned about people writing on approved prior credentials where that's part of how you got here. And that doesn't sound like anybody else. And Joan knows what I'm going to ask already. So, okay, back to the question then. So, yeah, my point here, what I was hoping you were going to say, Boston, sorry, was, yeah, I worked through some of these kinds of questions in my capstone. It's what should have happened. You should have had a question where you had to say, these would be relevant things to consider for the client. And if they do this, it turns into this. And if they don't, it turns into this. That's what you should be doing as part of that analysis in your financial planning process. But it's fine. If not, we are where we are. We can't do anything about it. We'll address it here. So the fact is, this is a legitimate financial planning question. And I'll show you this in the competency profile before we go to coffee here. And then, okay, what about this third answer? Is this relevant for Helen? So everybody's scared, eh? Okay. At least what this third answer does is it makes a connection back to the case study, okay? That Boston rightly recognizes that the DPSP is using RSP room, and that RSP room might be less than what we would want in order to maximize savings. Is that fair? So that's a connection to the case study. But now I'm going to pick on that connection to the case study. How much income does she earn? She makes $53,000 a year. How much RSP room does she have as a result? That'd be $9,560 of RSP room. Minus her PA, she would have a PA of up to $3,000. Is everybody with me here? So that'd be $6,560 of RSP room available. How many clients do you have who are single parents making $53,000 a year who are able to save, is that about 12% of gross income? That would be an unusual situation, wouldn't it? Now, maybe you do have it. I'm not suggesting it's impossible, but is it realistic to save enough to run into an RSP room problem? And I'm a little shaky on that. I can't say definitively, no, it's not. But it is something that I would consider before I give this answer. Okay, so really, Boston, to your answers here, if you just finish that out, you're all technically perfect. That's really good. But if you just finish that out with the comment about how it affects Helen, that will serve you really well on the exam. Okay, and it's good. You don't have overly wordy answers here. You're adding maybe a minute and a half to your time to answer by doing that. And I would suggest you're a lot more likely to get your marks that way. Okay, that's good. Yeah, I think this is a classic example, Boston, where you look at that and self-assessing, you would say, yeah, my answers are all right. And that's true. But without that second set of eyes, it's very hard to get that value out of it. Now, this leads to what I'm hoping everybody can do. I talked about this on day one, and I want to remind you of this. We still have lots of content after today. You would have at the very least the FP Canada practice exam and the second BCC exam. And I really strongly encourage you, instead of self-assessing, you team up with somebody and share your answers. This will be beneficial for both of you. You will get the benefit of seeing how somebody else answered the questions. And when that other person looks at your answers, they will pick up on your biases. They'll say, oh, you know, that's a good answer. It would have been better if you considered this, or if you used this technique, or you missed this part of the case study. All things you won't necessarily pick up with self-assessment. Okay. I know that's more work. I get that. But it's a far more effective use of your time. Okay. Yeah, and that's exactly it, Sharon. Just team up with somebody like that And you can share by email. You don't have to share in person. Well, at least until exam day, Tim. What we normally do is we just keep people in the course. When you pay a lump sum like Freedom did for you, we just keep people in the course really until the course changes, which won't happen right away, Tim. Okay. So I know I have students who wrote last semester and are back now this semester just using the recordings. Okay. Okay. Yeah, and you can post on the forums. You'll see, so exactly, Cameron, I don't know what Freedom 55 has for you in terms of a web resource. I don't know if you have access to whatever the Microsoft one is or Zoom or whatever. I assume there's something because Sarah seemed very comfortable presenting on a webinar. Yeah, perfect. So if you can set up your own internal WebEx, or you can use the or I don't know, some people have like Facebook groups internally or whatever it is. But yeah, there's a million ways to connect now, Cameron. That is like the lowest concern today, isn't it? Is finding a way to connect. Slack channel or a WeChat or a WhatsApp or whatever, right? Okay, like a million ways to do it. As long as you can share a file or take a screenshot of something or whatever, you'll be okay. All right, any questions here with this one? Okay, good. Thanks a lot, Boston. That's much appreciated. I just want to take a moment before we take our coffee break then. I'm going to show you what I was talking about. And this is actually, Sarah mentioned it. You're still, what are you, still 7 weeks, 6 weeks, 6 weeks from exam day. And this gives you lots of time to read in a little bit. Oh, Sharon, what was your question? Sorry. I have to go way back here, Sharon, and find your question. Oh, yeah. That is a good point. We'll talk about Canada Child Benefit after the coffee break, Sharon. That'll be a perfect intro to Canada Child Benefit. Yes, I like that. Okay. But in short, yes, I really like the Canada Child Benefit answer. Okay. And then after that, we'll talk about exam day and leading up to the exam. Okay, that'll work right there. Okay, FP Canada has this page called Exam Tools. Has anybody visited this? Okay, good. It's good if you have. It's no accident that it's called Exam Tools. This is all the stuff that the exam is based on. Yeah. In here, you want to use, for this exam anyways, at least for the next few weeks, this version, the CFP Professional Competency Profile. We actually looked at this together. Somebody had a question on day one, I can't remember who it was, about the technical knowledge appendix. And we looked at this briefly. Thanks, Tim. Yeah, it's long, Sharon. I'll show you what to read here. This would be one thing you would read on one of your days of study. You don't actually have to read all, whatever it is. It's actually like 54 pages, or I guess 48 pages. That's right. Honestly, just skip the first 10 pages. Okay. You don't care about this. It doesn't really help. It's all stuff we've done, not terribly useful. It's here that you want to start reading this thing. This is actually what the exam is based on. When that group of people who puts the exam together meets up, what'll actually happen is Susan, who heads up the exam creation process, will say, okay, folks, it's been a while since we tested 1.003. Can you give me a 1.003 question? Okay. It'll be pulled exactly out of this. And because of that it is worth giving this one read. You don't want to memorize it or anything ridiculous like that, but give it one read, especially if you're a foundational sort of person, if you like to understand where things come from. If you're a just show me the result person, this is probably a waste of your time. But if you're the person who says, why is it that way? This will help with the why is it that way. I've heard that question on this call at least a half dozen times now. Okay. Why is it this way? If that's the question you ask, this document is absolutely worth studying. If you say, whatever, just show me what I need to know, then yeah, that's probably not that good. But give it a read if you're in that category, and it will identify those exam questions. And you can see, what did we just look at? We looked at analysis on probably financial management. Okay, so we get into analysis, and you know the exam is heavily weighted towards analysis. We talked about that already. That's where you probably want to put in a little bit more time. Okay. You can see we've done some of these problems already. So this 2.103, we actually have done this a few different ways. We kind of did this yesterday when we talked about how long, I can't remember their couple, how long Vanessa and her husband's assets would last. Remember that after unemployment? Okay, potential cash management strategies. We had kind of a question around that where we talked about how to allocate that $10,000. So do you see where these questions link up with that reality or with the exam? Now, the question we just looked at would be actually right here, assesses financial alternatives. This is where you're actually making decisions. Sorry, you're building the tool to help make recommendations for the client. So this is exactly the skill set that you're testing there. And that's what I find people don't necessarily bring to the table enough for this exam, but it is a matter of not just what's technically true, but why does it matter to the client? Okay, all good? Okay, let's take a break there. I have 2 minutes past the hour. Let's take a 10-minute break. We will resume at 12 minutes past, and we'll have lunch in about 2 hours.